Welcome to The Explainer. In the world of venture capital, there's one decision that can make or break an entire fund. Today, we're cracking open the playbook to understand that high-stakes call, when to double down on a company that's already a winner. All right, so what's on the agenda? We're going to walk through their entire process. We'll start with understanding the stakes, then we'll look at a company's vital signs, the hard data. After that, we'll cover the signals of future success, how to read the market, how to actually place the bet, and finally, the big takeaway. So first up, let's talk about the core problem here, the big money dilemma that honestly keeps investors up at night. Here it is, the fundamental question, right? You invest too early and you're just burning through capital on a company that isn't ready. But if you wait too long, poof, the rocket ship has already left the launch pad and you've missed it. Getting this wrong is incredibly costly. Okay, so before we go any further, let's get our terms straight. We're talking about a follow-on investment. This is not the first check an investor writes. No. This is the crucial decision to reinvest, to pour more fuel on the fire for a company you've already backed, helping it scale up and really take on the world. So with all that pressure, how do VCs actually make the call? Well, they don't just guess. They start by looking at their dashboard, at the hard data, the vital signs that show what's really going on under the hood of a company. And first, and maybe the most important vital sign, is this thing called the LTV to CAC ratio. Now, it sounds complicated, but it's actually pretty simple. It just answers one critical question. Are you making more money from a customer than it costs you to get them through the door? And when VCs look at this, there is a magic number they are hunting for, a ratio of at least 3-to-1. That means for every single dollar you spend to get a new customer, you expect to make $3 back over their lifetime. That right there, that is a powerful signal of a healthy, scalable business model. Another key vital sign is, of course, revenue growth. But here's the thing you got to remember. What counts as good growth looks totally different depending on how mature the company is. For those super early stage companies, VCs need to see explosive month-over-month growth. But later on, the focus shifts to strong, sustainable expansion year after year. All right, let's talk about profitability, or at least the potential for it. For software companies, gross margin is absolute king. Investors are looking for a target of 80% or even higher. So why 80%? Well, because a high gross margin is like rocket fuel. It means the company has a ton of cash left over to reinvest in growth, marketing, and R&D. It screams scalability. But it's not just about those big headline numbers. The really smart VCs, they dig way deeper. They're asking all kinds of questions, like, are your customers actually sticking around? That's your churn rate. Is the company turning its cash into revenue efficiently? That's the burn multiple. And is that growth predictable? That's where recurring revenue is so important. Okay, but here's the deal. Numbers, they only tell half the story. The absolute best investors, they have a knack for reading the signs that don't show up on a spreadsheet. These are the real-world clues that tell you a company is truly about to break out. So what are they looking for? They're looking for proof, real tangible proof points. Have they hit that magical product market fit where customers are practically pulling the products out of their hands? Is the user base growing organically, on its own, not just because they're throwing money at ads? Are they diversifying their revenue so they're not reliant on just one big client? These are the milestones that separate a good idea from a truly scalable business. And this quote from Naimul Ab just nails it. These milestones, they aren't just items to check off a roadmap. Nope, they are tangible evidence that a business has what it takes to dominate its market. So, you've got a great company with strong metrics. That's fantastic. But it doesn't exist in a vacuum. A savvy investor also has to be kind of an expert meteorologist, constantly reading the economic weather to know when to set sail and when to maybe seek harbor. $89 billion. Just let that number sink in for a second. That's how much was invested in venture capital globally in just the first 3 months of 2024. This shows you just how much market sentiment and the flow of capital can create massive tailwinds or brutal headwinds for a startup looking for money. And historical events teach really powerful lessons. I mean, think back to early 2020. The pandemic hits, markets absolutely crater, and uncertainty is everywhere. But then, just a few months later, thanks to policy stimulus, they come a roaring back. The companies that secured follow-on funding during that downturn were perfectly positioned to ride the recovery wave. It's an absolute masterclass in adapting to massive, sudden shifts. Okay, so the company is strong, and the market timing feels right. Now for the final piece of the puzzle. How do venture capitalists strategically place their bets and master their capital allocation? This reveals a core principle of venture capital. A top-tier firm doesn't invest all its money up front. No way. They strategically reserve a huge portion of their fund, often 40 to 60%, because they know their biggest returns, the legendary ones, will come from doubling down on their winners. And there are different ways to manage those reserves. You've got the percentage of fund strategy, which is really simple and disciplined. Then there's the what's left strategy, which focuses on getting a target ownership stake early and then using what's left for follow-ons. Each one has its own trade-offs, right? It's a balancing act between discipline, ownership, and flexibility. But, after all the metrics and all the strategies, it really comes down to this timeless wisdom from venture pioneer Arthur Rock. VCs aren't just investing in code or a business model. Fundamentally, they are betting on people, on their ability to execute. So, after this deep dive into the VC's mind, what's the ultimate takeaway? How do you synthesize this entire playbook? Successful timing isn't about one magic bullet. It's a synthesis of these three pillars. It requires a rigorous analysis of the data, a clear-eyed view of those real-world milestones, and a sharp awareness of the broader market. When all three of those things align, that's the signal to invest. And that brings us to our final provocative question. What do you do when the numbers are good, but the founders just seem a little lost? Where do you place your bet? This highlights that delicate balance at the heart of every great investment decision, that constant interplay between the art of judging people and the science of reading the data. Thanks for joining us on The Explainer.